strategy component of where you deploy your marketing budget or who you have on your team, and all of those components are not going to change. And so we focus a lot of our messaging along those lines to stand out in the marketplace.
Welcome to the Agency Profit Podcast, a show dedicated to going deep space on agency operations, which is just as nerdy as it sounds. I'm your host, Marcel Petitpoff. I'm the CEO of Parakeeto, a firm that helps digital and creative agencies measure and improve their profitability. Join me as I interview some of the smartest thought leaders and agency owners in our space and go deep into operations, metrics, and all the other things you need to get right so you can spend less time worrying about operations and more time executing on your vision. Hello, everyone, and welcome back to the Agency Profit Podcast. I'm pleased today to be joined by Shiv Narayanan, who's the CEO of How To SaaS and specializes in marketing, but in the context specifically of mergers and acquisitions, both pre and post merger or acquisition, to really influence valuation and deal flow and all the things that are important when you're talking about exiting a firm. He has built and sold a company. He is now running a professional services firm, and I'm really excited to talk about this really specific application and talk about how marketing can influence something as significant as an exit in the business. So Shiv, I appreciate you being here to talk about this today.
Thanks for having me on. We're so excited to be here.
So let's just start with some background, because you've got a pretty strong track record and are building a very successful consulting firm. So, what do you do and who do you serve, and how did you get to this point?
Yeah, so I run a firm called How To SaaS, and we work primarily with private equity investors and software companies to help them build a more predictable, scientific approach to marketing and demand generation. And it primarily, the way that I would say there's three solutions that we help them with. Number one is we help investors as they're looking at a target investment, and we provide them with due diligence services. So you're probably familiar with financial due diligence. We do that on the marketing side. Number two is we do strategy consulting. We help them figure out how to optimize their existing investments or a new company that they're deploying capital into. And the third is that we provide fractional CMO services. If they don't have a CMO in place or the CEO's playing that role, we help them operationally manage the team, work with their executive team, and present and figure out things with the board at a strategic level as well.
Awesome. And what led you to this focus on specifically working with private equity investors, SaaS companies in this kind of M&A context?
Yeah, so previously I was the CMO of a software company called Wild Apricot. We sold that to private equity back in 2017. And then the PE firm that bought us flipped us to a different private equity firm in 2018. And through both of those transactions, I really learned a lot about the private equity world. And both of our PE investors started pulling me into their other investments, saying, can you help us out and help us figure out the marketing side of these businesses? And so I saw that as an opportunity. And instead of helping them from the inside, I decided to create an outside firm that partners primarily with the PE investors. And there's a big need for that in the marketplace, because a lot of these private equity investors are either financial guys or really focused on things like sales or pricing as their main value creation drivers, where marketing is often overlooked. So saw that as a huge opportunity and created this firm from there.
You know what I love so much about this is, my guess is at a fundamental level, the things that you're doing, when you go in and look at doing the diligence process on a marketing part of a business, or going in and, really dialing things in on the demand gen side to, like at a fundamental level, it's marketing. And there's probably a lot of other firms, a lot of other experts that could do similar things. However, you've positioned this and focused it on such a specific problem and such a specific outcome for such a specific person that it is like wildly differentiated you. And I think that is just like at a meta level, such a fascinating thing. And I want to double click on it because it speaks to the power of positioning.
Totally. So I think there's two aspects to that. One is the positioning itself. And you're absolutely right that there are a lot of things that we will do for clients that, let's say, a traditional agency would be able to do. There's thousands of agencies that can do SEO, thousands of agencies that can do Google ads or LinkedIn ads, and we do some of that work. I think before positioning, it's really understanding product, and product is a function of the end customer. So let's say you're an SEO agency, your end customer is often the VP of marketing or the head of SEO at a company that are trying to increase their organic traffic. And so you're going to create a proposal, and there's going to be a set of initiatives that you're addressing for that type of buyer. In our case, the buyer is actually the investor, and the needs are just so different that to understand that, you actually need to step into their shoes and understand their day-to-day reality and what kind of pressures they're dealing with, what their objectives are, what they're trying to accomplish with these companies, and what level at which they're trying to have these conversations. And so then you take some of the tactical or commoditized things like SEO or pay-per-click or whatever else that you're looking at, but being able to bring it to a higher level so that these investors can actually understand what to do with their companies and ultimately how to generate a return on the capital that they're investing into these companies. And so having a product that actually addresses that need took some time to get to that product market fit, if you will, with this market, because I could have easily just started an agency that provides paid media services and gone after the VPs of marketing because they have a line item in their budget. In this case, we almost created a new category because there's no such thing. If you look up marketing due diligence services, we're like the only firm that really comes up. And so it's like trying to educate the market for the need of this. And that's why I've written the books and put out all the content that I have. And then you get into the positioning piece of, okay, now we have the product, how we are actually going to serve these customers. So how do we now explain that to the market and how do we position ourselves? And we don't talk about tactics because tactics change overnight, right? Like right now, LLMs are all the buzzwords and paid media is going down, SEO organic traffic is going down. And it might be in 5 years, none of those channels are actually relevant. But the strategy component of where you deploy your marketing budget or who you have on your team and all of those components are not going to change. And so we focus a lot of our messaging along those lines to stand out in the marketplace.
It's so like there's some nuance to this, but I really want to like read back what I'm hearing because I think it's so important. It's such an important nuance. Like the marketing due diligence to me is such a perfect example of this. It's brilliant because I could tell you about 100 firms that I know of that will do an audit, you know, a marketing audit or an assessment or a strategy. And it will involve going in, looking at what they're doing, finding the opportunities, making recommendations, like all of these things. And the funny thing is none of that matters to the person that they're talking to.
Yes.
And you like, it's such a clear and simple articulation of this person needs to do due diligence. It doesn't matter that the things that need to happen in order for that diligence to be done might be very similar to a bunch of alternatives that might, you know, exist elsewhere. It's important that I be able to articulate to them how I'm going to help them solve that problem in their context. And I'm sure that there are specific things that you do differently now that you deeply understand what it means to do diligence in that context. And so the product really is differentiated. But the point that you made there about the tactics and not speaking about those and working backwards from what that customer needs and what their problem is and what their perspective is, that illustrates it so beautifully.
Yeah, just to bring this to life a little bit more, right? Like I can't tell you how many times I've come in to advise a company or play the role of fractional CMO or been looking in a due diligence process, and the target investment or the company may already have multiple agencies or at least one agency that they're working with, but a lot of the stuff that the agency is working on or that the team is working on is either inefficient or the wrong things to be working on. And so I think the differentiator on our side, and we talk about this a lot internally, is that we bring C-level marketing expertise that is connected to what the board objectives are, what the CEO is trying to do. And if you kind of cascade things down, like things like SEO or paid media are either functional or subject matter specific tactics. But if you go a level higher, like paid media is a subset of demand generation strategy. Demand generation strategy is a subset of marketing strategy. Marketing strategy is a subset of go-to-market, and go-to-market is a subset of overall company strategy. And so really understanding the company strategy, the investment thesis, why someone is deploying capital into a particular company, what the context of the business is, how much cash do they have, what are their financials, and how does that make an impact on decisions? all of a sudden, all the tactics that you're focused on can be very different. Like you could spend a year on SEO, for example, and try to ramp up organic traffic, and it doesn't change what the board objectives might be or actually move the needle on the things that really matter. And so changing that those priorities is super important. And so having a partner at the table that understands how to prioritize things and then how to allocate limited budget ends up becoming a huge differentiator, because most agencies don't understand that. And that's okay, by the way. There could be agencies that whose ideal customer is a VP of marketing who already knows their priorities and they just need to deploy money into paid media. And that's just a different market to play in. For us, we chose to focus on the former because that's where our secret sauce is and what our differentiators are. I'd be the first person to tell you we're not the best paid media agency for a company, but we are better than everybody out there in terms of that C-level marketing expertise.
So that leads me to another kind of set of questions. We're shifting gears here a little bit. I thought that was interesting, though, just like really looking at your positioning at a meta level, because you've done such a great job with it again, and differentiating yourself in that way and then making specific solutions. With that, though, comes a lot now of experience with really seeing and understanding the impact that how you market influences valuation, both leading up to an exit, but then also after an exit, if we're in a situation where there's a larger thesis that that first transaction is leading into. So can you share a little bit more about, how marketing strategy really affects and is influenced by a merger or an acquisition or essentially a liquidation event within a business?
Yeah. So before we look at the marketing strategy, you first have to understand, what does a buyer actually care about when they're acquiring a company? And there's like a handful of factors that swing deals, or at the very least kill deals. Even if, let's say, you have an LOI sign, I'm sure there are people in your audience that have gone through some sort of an exit process only to have the deal fall apart. And that's actually the first story in the new book that just came out that I wrote, where it's a founder whose deal fell apart, because I've seen that happen just so many times, is that once you get an LOI signed, they start running an extended due diligence process to understand what is the quality of this business and how much risk is involved in purchasing this thing, and what is the future expectation. And at a very basic level in finance, is just you have to discount future cash flows just to understand what the value of a particular asset is today. And so for a business, what you really want to know is, first thing, what is the quality of earnings? The revenue that's being made, do we have predictable revenue? Is it scalable? Is it lumpy? Is it kind of sporadic? Because that in itself is a deal killer. If you have some months where you're doing 200,000 in revenue, other months where you're doing 50,000, all of a sudden your business doesn't look as dependable or as reliable as a business that's consistently, let's say, doing 100,000 in revenue. So I'd say that's step one. Number two is just looking at things like customer concentration. Is a big chunk of your revenue stuck in one or two large customers? And a lot of companies are victim to this, where they may have one or two huge clients and then a bunch of smaller clients that make up like 20% of their revenue, but 80% of their revenue comes from those larger clients. And you want to have more of an even revenue distribution so that you don't have single customer concentration risk, or if they churn, like your business is basically going under. Third is just looking at how long customers stay with you. Are they sticky? Are they actually going to be customers with you for next year? Are they going to expand their business with you over time? And in every company's profile, especially agencies, where in the last year, I've talked to multiple agency owners that are friends, and they've seen a lot more churn than they had in previous years as budgets are getting tighter and companies are trying to figure out how to best allocate their limited marketing dollars. And so if you're experiencing a lot of churn, it's harder to get acquired because every revenue that comes in the door is at risk of being out the door in like less than a year. And so just looking at and there's a bunch of other things like your management team and everything else, but let's just start with this revenue piece. Is getting the revenue piece is just so important that if you don't get it right, the odds of you being acquired can either basically be zero. And so the way you fix that is by understanding which ideal customer makes up the bulk of your revenue that is predictable and scalable. So in your particular business, you might find that some subset of customers churn way more than others. You may also find that the same subset that stays longer with you also has a larger deal size or likely expands their business with you to other offerings over time. The more time you spend understanding those nuances and figuring out of, let's say, the A, B, C, D, E segments in your existing customer list, which ones are your ideal fit, then you can take that data and now bring it to your go to market and say, these are actually the people that I want to focus on. And I can tell you just from the early days of How to SaaS, the number of times I've said no to clients, even though there was revenue on the table or contracts on the table, it's countless, because I knew either it was bad quality revenue or it was a huge distraction. And in general, agencies and professional services firms tend to say yes to everything because you don't want to turn away business. You want to take on the cash, and you are a cash flow in, cash flow out type of business, right? So if you say no to that, you kind of feel like you're giving away money or losing money on the back end. But the truth is that you're actually distracting yourself and not sticking to a core set of customers around which you can build a business. And a good comparison to this is like, let's do something super simple. Let's say you have a company that paints houses for a living. To build a business that paints houses, you need certain materials, you need certain types of skilled labor, you need certain processes in place, there's certain economics involved. If all of a sudden you now start offering roofing services, you need the same set of same types of things for that other business as well. And in agencies, what ends up happening is the more types of customers you serve, each one is a different product line almost, that requires different processes, people, frameworks, budget. And before you know it, you have 10 to 15 different clients with different processes, and everybody's kind of spread thin. And what you actually want is you want everything to kind of taste like chicken. Everything should be repeatable and scalable, and it should be focused on the people that are your best fit customers, so that long term you actually have higher residual value from those customers. So I'd say that's the connection to the marketing side, is really nailing down who you're going after and then starting to build your go-to-market from there.
Do you want some free resources to help you measure and improve your profitability? If you do, then I want to tell you about our agency profitability toolkit, which you can grab absolutely free in the show notes or by heading to parakeeto.com/toolkit. It's packed with training videos, cheat sheets, templates, and all kinds of other great resources to help you start measuring and improving the essential metrics that are going to drive better profitability in your business. And it's helped thousands of other agencies around the world do the same. So I want to encourage you to go and grab a copy of that. And if you'd rather get in the fast lane and just have our team of experts guide you through the process of measuring and improving your profitability, then I want to encourage you to apply for a consultation at parakeeto.com. And with that, I want to thank you again for tuning in. I hope you enjoy the episode, and I'll let you get back to it. What's interesting about this is it leads into the next kind of set of questions that I was going to ask, which was around, what we've talked about here is blue chip stuff. It's quality of earnings. It's the foundation that regardless of who's buying you is going to drive, the reliable, predictable portion of the enterprise value of an organization. In the context of private equity, this is pretty much what they're looking at. Entrepreneurial buyer, this is pretty much what they're looking at. Then there's the whole other side of things, which is a strategic exit of some kind. But what's great about this strategy is it works on the blue chip stuff by increasing the quality of your earnings, while also positioning you more specifically, which I would imagine is probably one of the largest determining factors in whether or not you're going to be positioned for some kind of a strategic exit that might give you an outsized, valuation relative to your earnings at a given point in time.
Yeah, 100%. The tighter this definition of who you're going after and exactly where you play, the higher the value of your business, which is kind of counterintuitive, even if you have lesser revenue, because it's not a question of whether you have more revenue. It's a question of whether you are built to be acquired in the first place. And so focusing on the right folks. And then what you say is, okay, out of these A, B, C, D, E segments, like the customers that are A customers have these characteristics. Now I'm going to go after them and have a go-to-market plan that really focuses on that. On our side, that was always the private equity investor. And I would say that that's our moat or competitive differentiation or advantage in this marketplace. Even if there's an agency listening to this, they want to go into the private equity space to catch up and try to compete with us, they'd have to build so many private equity relationships that's our strategic advantage. On the flip side, if I was to try to go and create like a creative agency, we just wouldn't be able to compete in that space because we are not built for that, even though creative agency opportunities cross our desk all the time. And so having the confidence to be able to say no then ends up building a more successful enterprise.
It's fascinating because if I was to think about, some larger firm or a tech company or what have you wants to come in and acquire your business because they already sell to private equity firms and there's a cross-selling or a synergistic opportunity there, like you have a significant wedge for more of a strategic conversation around that acquisition because you're so tightly positioned and because you have a brand there and you have authority. Like the value of that skyrockets in that specific context, but because you've been positioned for it.
100%. I would say that that is one of our biggest assets is the relationships. And one of the things that we look at is instead of revenue per client on an annual basis, we look at revenue per private equity firm on an annual basis to see which relationships are growing over time and which PE partners are actually our bigger partners. And then we strategically think about which PE partners do we want to focus on to grow our business with them, to work on more of their portfolio companies. There's one other important thing I want to touch on, which is a sidebar here, is in agencies, one of the dirty truths about the agency market is that a lot of agencies have to keep hiring headcount to support more clients. And a lot of agencies only have 2-3 months of cash flow runway. If an agency, if a client cancels, they likely have to let folks go because there isn't enough cash on hand to be able to sustain the headcount that they have. So they're kind of like almost like an outsourced arm of their clients. And then they hire/fire based on the situation that exists with their clients. And the reason for this is that there's not enough focus, because when you look at the financials of a company, and this is the other side of potentially being acquired as a services company, is one of the most important metrics is actually gross margin. And ideally, you want to, as a services firm, you want a gross margin that's north of 50%, but ideally over 70%, because that gives you enough margin to work with to have staff on hand that isn't completely reliant on a customer not churning. And so the more focused you are, then you need lesser people because you are duplicating your processes more client by client, and you're less distracted and offering different things to different clients. And you need less people to be able to sustain that. And you get economies of scale and your gross margin goes up over time. As your gross margin goes up over time, you become a much more attractive investment for potential strategics or financial investors that want to buy your business as well.
You are preaching to the choir. It's funny because I don't think you've listened to our show before. So you wouldn't know that this is like all we talk about is what you're defining as gross margin. We would probably define as delivery margin, but essentially it's like, yeah, out of every dollar a client gives you, how much of that does it cost you to earn that revenue and get the promise delivered? And you want as much of that money left over as possible to be able to then invest in overhead and growth and have cash reserves and have profit. And the more you have in terms of what you're qualifying as gross margin, the more optionality essentially you have, and the more stable and reliable and high quality your revenue is. So it sounds like in your experience, increasing that focus has led to better margins for you. And that's certainly been a trend that we've seen across our clients as well. The better position and more focused they are, typically the higher their margins are.
Completely agree, and we're aligned on that. One thing I'd like to think about or like to talk to folks about is just this concept of being a virtuoso, which is like being really good at one thing. Like we don't need to be, I'm just speaking about our business, we don't need to be the best marketing agency in the world. We just need to be the best strategic consulting firm for private equity firms in the world. And if we're that and we focus all of our resources on being that, there will always be a portion of the market available to us. And then we will lose business to others in other areas. But being world-class in one specific domain expands margins, but also helps you deliver a better product to clients and actually create more value in the marketplace and have a more loyal customer base that sends you more referrals and repeat business and all of those things. So I think the more focused you are, the simple statement is just that you create more value and just a better business.
Yeah. And this is a trend that, I mean, I'm going to take a sidebar here as well, because this is a soapbox that I've been getting on a little bit. You touched on something I think is really important. The macro idea here is your valuation is influenced by the quality of your earnings. The quality of your earnings is dictated by essentially how predictable it is, how stable it is, how redundant it is to change, and the margin that it has. And within that, there are a couple of ideas. How repeatably and reliably can you attract that high quality revenue from specific clients? There's this other kind of strategic lens on this, which is how clearly are you positioned? That might help your valuation as well. And then there's this last piece that I've been talking about a lot, which is, external specialization. It's what we've spent a lot of this episode talking about. It's not a new concept. I think as an industry, a lot of people have been talking about this for the last 2 decades, roughly, and it's kind of becoming table stakes. Like if you're not specific about who you serve, then it's going to be really hard. And I think you've articulated a lot of the reasons why it's going to be hard. The other thing that you kind of touched on, but I want to double click on more, is the internal specialization. So what I'm observing is the most profitable firms that we're auditing are not only really clear about who they serve and what problem they solve in the market, they're also getting really clear about, as business owners and as operators, what are they experts at in terms of their own operations. And they start to actually stop doing things internally that they're not good at. So for example, if I was an SEO agency and I was really good at the strategy and the account management, but I was not great at backlink building, I wasn't great at writing content, I might partner with other expert firms to do that stuff and be able to scale much faster and have higher quality earnings internally, because that's my area of expertise and I can scale that operation much more clearly. Is that something that you have found personally has been a trend as well, or that you're seeing with other firms?
Yeah, 100%. I mean, we do that ourselves. So like I mentioned, we look at ourselves as a C-level marketing expert. So we'll come into a company and let's say their website needs work. We have a large network of website agencies that we will bring in and we will hire on behalf of the client to overhaul the website. If it's paid media, we have a large network of paid media agencies, or SEO, same thing. So we are not building that capacity internally on purpose. It's just building a large network of those folks that can be plugged in. And that means that we can still deliver value to the client. And upfront in our sales process, we're asked like, hey, I know you're coming in as our fractional CMO or auditing this business. Are you also going to do our paid media and spend and management? And the answer is no, we're not going to do that, but we can manage it for you. And here's our approach to that. And then we'll connect you with firms and roughly here's how much it'll cost on top. But that has nothing to do with our spend. And we're super clear upfront so that the expectations are set correctly. And at the same time, it's not like we lower our pricing. It's like we're very confident in the value that we're bringing, and we're able to charge a premium price for that, even if certain components like website or SEO or paid media are not included. And that allows us to keep our gross margins high.
I'm so glad you brought that up, because that conversation with the client is a trap. And many of us are guilty of falling into that trap. The other trap is when you are working with, like, let's say a CFO or an accountant that doesn't understand the agency business model, and they think your gross margin is revenue minus those pass-through expenses that go to other vendors. So they start pointing at that and they're like, oh, you're spending too much on COGS. And they don't understand that it's like, that's not our business model.
Right.
That's not revenue that we want. Just because it exists, it doesn't mean that we should like try to bring that internally because of all the operational drag that you've mentioned. I think that's so important, right? It's like most agencies suffer from indigestion, not starvation.
100%. Yeah. And I want to expand on the sales conversation part, because I think this one is one of the most overlooked or highest value areas for agencies and professional services firms, is the conversation you have with the client or a prospect when you're selling is probably the most important. It's like the decisive moment in terms of how your firm is going to be built. And building on top of what we were saying earlier, your ideal customer, what your position, which market you're going to position yourself against, what your product is, all of that kind of comes together when you give that first sales presentation, and being super clear and having like a productized version of, this is how much our services are, here's what's included, here's what's not included, here's what we will do, here's our timeline, here are the deliverables, here's how much it will cost exactly, whether it's a monthly retainer, project-based fee, whatever your model is, and having a clear set of objection handling questions. And a clear objection would be, well, I was hoping to get paid media services along with this. Well, yeah, that's not what we do. But also looking at your current marketing situation, you need to get your strategy in order before you go to an agency, because we've seen plenty of companies invest in agencies that first hire the agency, make mistakes, then fire the agency, and then come to someone like us. So getting this right the first time is super important. So things like that, just making sure your objection handling is on point at the exact type of customer that you're going after. And then not being afraid to lose deals in that moment where you may give your pitch and they might be looking for something else. And if they are looking for something else, refer them to a partner, refer them to someone else, because they're not exactly looking for what you offer.
Well, with all that, Shiv, there's one last thing that we haven't talked about, which is once you have an exit, let's assume you've sold to something like a private equity firm or, to a large strategic, and there's a larger thesis now that you're rolling into. Maybe they're trying to do a roll-up play, or they're trying to flip the business, or they're trying to merge it with another business. How does that post-exit strategy influence marketing?
Yeah, I think the first step is to understand why somebody bought you in the first place. So did they buy you just to buy your revenue or your clients, or did they buy you as a strategic acquisition, or are they investing in you as a platform and they're going to buy additional companies under you? Really understanding that is the first step. And then once you understand that investment thesis, then you start to formulate where you focus your energy post acquisition. And that can take so many different forms in every instance. But no matter what the situation is, there's 3 to 5 areas that you need to optimize for every time. One is just, what is your marketing budget? And just overall go to market budget. Where is it focused and how much of it are you deploying? And are there efficiencies and inefficiencies inside that budget that you can optimize for? And I'd say most companies that we audit have 30 to 50% inefficiency in their go to market spend, because nobody actually looks at it. And a lot of agencies are founder led, and it's kind of like off the cuff. You don't have the discipline that you would once a financial investor comes in, because they're looking at ongoing board reporting, actual accountability for every function. So having that proper full board level reporting for your go to market efficiency is super important, so that you can make the right decision on what's the right size budget for this business. And also just connecting that to the number of people you need to make those initiatives a reality, because it might be that, let's say you're a 20-person agency today, it might be that you actually need more people to get to where you want to get to, but you haven't done the data-driven work to actually be able to explain that to an investor once they're at the table with you, and you have to make your decisions alongside them, not just by yourself as an agency owner. So I'd say that's one. Number two is really being clear on what are all the strategic opportunities available after an acquisition is made. It could be that there's a ton of cross-sell and upsell opportunity with the acquirer. Maybe you've been acquired by a strategic where they sell data services and you sell paid media services. Well, you could kind of cross-sell those to each other or bundle those things together. So there's pricing opportunities, there's sales opportunities, and really understanding that and getting plugged into all the different components. And your investor would have modeled that out as they're looking at the acquisition and thinking about, okay, I'm going to deploy this much capital, but I'm going to make this capital back by doing this and this, number one, number two, number three, as main focus initiatives and what those are. And what I'd advise agency owners to just think about is try to do some of those things before you get acquired, because the more of the things that you do post-acquisition, that you like, more of the things that you do pre-acquisition that you would do post-acquisition will increase your company's enterprise value. So we talked about making your revenue more predictable, but at the same time, like if there are, for example, pricing opportunities or bundling opportunities or strategic initiatives that you can invest into, if you can invest in that before you get acquired, that might increase your multiple by 2 or 3x more. It might maybe add a little bit of top line revenue that shows more predictability. And so the more that you do ahead of time, the better it is. But even if you don't, at least post acquisition, those become initiatives that become a way to really drive enterprise value. And then the third is just your standard go to market that ends up getting way more scrutiny, because you're actually thinking about, and I just say go to market, but it's overall operations in terms of your margin on a client by client basis, maybe your internal processes, basic things like project management or time tracking or everything else that you kind of have in place, along with things that you're really spending money on. Maybe you go to a ton of trade shows, maybe you speak at events, maybe you write books, whatever it is, just being super clear on where your budget is being deployed and what is the ROI on the investment, and having the discipline to be able to kind of think about that and bringing that to the investor at a level that they can digest it, because they don't live in the world of tactics, right? So being able to tell that story effectively.
All right. You've touched on a lot of things. I know we're kind of getting to time here, Shiv, and you're a busy guy. I want to talk very quickly about two books that you've written, one which is a bestseller, one which has just come out, covering both pre and post acquisition marketing. So for those that want to learn more about those, where should we send them in the show notes?
Yeah, I'd say check out my new book. It's called Exit Ready Marketing. It's a framework for founders to increase their valuation, and it walks through a lot of the things that we talked about on today's episode. It actually just reached bestseller status last week as well, so highly recommend it. And then the other one is Post-Acquisition Marketing. I wrote that a few years back when I first started the business. And at the very least, at a meta level, it's worth checking out for agency owners, because I would look at those two books as almost like our product marketing or sales enablement that we've done for our own agency to position ourselves in this marketplace as a high-level strategic consulting firm that works with private equity firms.
Awesome. So we'll leave links to both the new book, Exit Ready Marketing, as well as the previous book that you'd written, Post Acquisition Marketing, in the show notes. We'll also leave some links to Shiv's socials, his website, if you want to go check out more of his content. And with that, Shiv, I really appreciate you making some time to come on and just kind of share your story, share your perspective. I think it was a really great case study at a meta level in what it looks like to do some great positioning as a firm and have a strong point of view.
Thanks for having me on, Marcel. This was great. Appreciate it.
Hey, thanks so much for tuning in to today's episode. I hope you enjoyed it. And if you've ever found yourself thinking, man, I get so much value from this podcast, I wish there was something I could do to return the favor. Well, today's your lucky day, because you can leave us a review wherever you're listening to this, and it is incredibly helpful. Of course, if you haven't grabbed a free copy of the Agency Profit Toolkit, go and get that. It's got tons of free resources to help you improve your profitability. If you're looking to get in the fast lane and get help from experts to improve your profitability and measure your most important metrics, then apply for a consultation at Parakeeto.com. We'd love to chat with you and figure out how we can help. With all of that, thank you so much for being a listener, and we will see you on the next episode.